New age stocks were the hype when they hit the IPO markets. But what has happened to them? Well, in this video, I, Siddharth Singh Bhaisora, along with my colleague Siddharth Agarwal, will go over 5 new age stocks and understand how they've performed financially, their strengths, their challenges, and also look at the stock's performance. Make sure to like, subscribe, and comment on this video. It really helps us out with the YouTube algorithm and helps us reach more people. Comment on what other sectors you want us to cover. So let's get into it. Paytm's financial results for the first quarter of this financial year signaled mixed fortunes. Despite a 44.6% year-on-year reduction in its net loss, and the figure has more than doubled on a sequential basis, the company has reported a 358 crore loss, even as its operating revenue has increased by about 39% on a year-on-year basis to 2,342 crores. It has also announced an additional 1.7 million employee stock options, which could continue to push the bottom line. There are a few positives for Paytm. Paytm's momentum in high margin lending and soundbox business remains good for at least the next 3 to 4 quarters. It also intends to disrupt the small mobile credit market in the country via its digital loan collection on the app. According to Vijay Shekhar Sharma, a loan of as small as few hundred rupees can be disbursed and collected at a very minuscule cost. So these are a few positives for the company. What has happened from a shareholding perspective adds another layer of complexity to the Paytm saga. Antfin, which was a significant investor in Paytm, has recently sold a 3.6% stake in the company, which is equivalent to about 2.27 crores shares worth over 2,037 crores. Prior to the sale, as of June 2023, Antfin, which is a Chinese company, held around 23.79% stake in Paytm. This follows a off-market transaction as well, where Antfin transferred 10.3% of its shares to Paytm's founder Vijay Shekhar Sharma. Sharma will acquire voting and ownership rights, while Antfil will retain the economic rights via a NCD or a non-convertible debentures transaction. There was no exchange of cash in this transaction. From a regulatory perspective, what all of this means is that the change in the shareholding is a good sign, since it removes the potential stock supply concerns from Antfil selling in the broader market. It also reduces the risk of a strategic investor coming in and taking a large position in the company. Antfin is also a Chinese company, like we mentioned earlier, and was a major shareholder in the company. The fact that it's not the largest shareholder now is also viewed positively given the geopolitical climate that we are in right now. RBI's perspective, earlier they had declined Paytm's payment services license application. But with this new development, we expect, there was enough time for them to sort of get the compliances and have the necessary foreign direct investment guidelines met. In terms of the stock's performance, let's sort of jump into that quickly. Here's a quick graph for you. So Paytm shares have had a sideways movement on much of August, but on the whole has been up about 10.54% in the month. And the stock is ended about 857 rupees as of Friday this week. On a 6-month basis, it is up by about 42%, and on a year-to-date basis, it's up by about 62% and has done really well in this year. It has also performed well in July when the markets were doing well, but again, when we look at its IPO price, it is down around 45%. Despite all of this, the experts in the market opinion right now is that the stock is favored and there is a lot of optimism behind it. It does appear to be range bound, but there is a lot of bullish sentiment around it. We can see resistance at about 875 rupees and support maybe around the 800 rupee mark. If the stock sustains above 880, there could be a significant upward trend beyond that as well.
Interesting company called EaseMyTrip. EaseMyTrip's quarter 1 financials show mixed results amid the travel industry fluctuation that's happening. The online travel service provider reported a 21.46% year-on-year decline in consolidated net profit to rupees 26 crores for Q1 FY24, down from 33.13 crore in the same period last year. So the net profit has fallen from 33 crores to 26 crores. Interestingly, the dip in profit occurred despite a 41.6% year on year rise in operating revenue. which stood at 124.05 crores compared to 87.58 crore a year ago. So basically, what's happening is that the operating revenue is rising by 41% year on year, while the net profit is declining by 21.4% year on year. Now, why is this happening? The total expense for the firm surged to 91.56 crores, nearly doubling the expense of 47 crores from Q1 last year. So, from 47 crores, their expenses have doubled to 91 crores. Now, what is the reason for this? The increase is largely attributed to higher advertising, payment gateway charges, and employee costs as operations have scaled. EaseMyTrip also cited deep discounts offered during its 15th anniversary celebrations in early June as a reason for the profit decline. Let's have a look at the income statement. If we look at the quarterly income statement, it is pretty evident that the revenue has been rising, operating expense has doubled, net income has, of course, fallen, and net profit margin also has fallen. And the reason for this is the operating expense sort of doubling. Now, there are still some positives, right? The management is upbeat and optimistic about the company's growth on the back of revenge travel and pent up demand from COVID. Yes, this is still a thing, right? People are doing revenge travel, and this is benefiting companies like EaseMyTrip. Company's gross booking revenue rose by 43%, outpacing the 19% growth reported by the DGCA. This indicates that EaseMyTrip is gaining market share, suggesting a strong position amid sector-wide growth. EaseMyTrip has sold 32.1 lakh air tickets, of course, after accounting for cancellations, and this has been a notable year for growth of 43.3%. Now, the total hotel nights sold in the quarter reached 1.6 lakh, a significant increase compared to zero point 0.7 lakh recorded in the same quarter last year. The hotel business is expected to reach a break even point or turn profitable in quarter two. Hotel business showed a 123% year on year growth. So now the hotel business vertical can also turn profitable in quarter two, and this is the expectation. Also, given the fact that the cricket World Cup is around the corner, this is going to bolster the travel and hospitality sector in India significantly. Prices for the flights and accommodations are skyrocketing, particularly in cities hosting these matches. It also presents an opportunity for EaseMyTrip's international platform, serving markets like the UK, the Middle East, to see increased booking volumes from non resident Indians wishing to attend the event. Talking about the financials of the company, it is also important to talk about the stock price of the company. So let's have a brief look at the stock price. The chart is right in front of you, and as you can see that EaseMyTrip shares have had a sideway movement for much of August, showing a marginal 0.5% increase in the month. While for the stock ending at rupees 40 as of Friday, most of the new age stocks have performed well and bounced back this year compared to the sharp drops in 2022. On a 6 month basis, it is down 18.5%, and on a year to date, which is Y to D basis, it is down 23.7%. It showed sideways performance in July as well, but from its IPO price, it is down around 21%. If the stock can break the resistance at 42, it could rally upwards to around 46 to 48 in the
Delhivery,
short
a
term.
logistics unicorn, is showing signs of steady financial health by significantly reducing its net losses in quarter one of the current financial year. So let's look at the key financials. Here they are. Revenue increased by 11% on a year-on-year basis to 1,929 crores. Express, parcel, and part truckload segments have shown strong growth with revenue growths of about 14% and 34% on a year-on-year basis, respectively. The adjusted EBITDA loss has declined by 89% on a year-on-year basis to about 25 crores, with the margin improving from minus 12.5% to minus 1.3%. This is a very, very good sign for the company. Total expenses, they've reduced by about 3.4% on a year-on-year basis to about 2,129 crores. In terms of freight handling, servicing costs fell from rupees 1,452 crores in quarter one FY23 to 1,438 crores in quarter one FY24. The net loss has reduced by about 78% for the company on a year-on-year basis to about 89.5 crores, and on a quarter-on-quarter basis, it has fallen by about 44%. There are a few positives for Delhivery, so let's quickly look at them. They've secured critical contracts in quarter one from large players like Havells, Tata Motors, Mama Earth, and many more. And a lot of those should have positive impacts on the earnings in the coming quarters. They've also launched a digital platform, a digital shipping platform for MSMEs specifically and large D2C e commerce brands in India. This is ultimately aimed to optimize the processes and reduce the cost for these brands. It offers various shipping services, includes post-purchase communication, analytics, international shipping, and a lot more. And so, as a whole, this looks like a very strong solution for the MSME and the D2C sector. In terms of future enhancements, they're also working on a lot of AI powered return to origin predictors. They're integrating their marketplace and mobile app and shipping credits with all of this sort of AI focused tools, and that should have a positive impact on the company. Shareholdings, Carlyle Group, which is one of the earlier investors in the company, has exited its stake in Delhivery through block deals to Goldman Sachs and BNP. They've made about 2.7x returns on their investments, which is pretty impressive. In terms of the stock movement, you can have a look at the 6 month chart here. What we can see is that delivery shares have performed decently in the month of August, and they're up about 8.87%. In the current month, the stock has ended about 437 rupees as of Friday this week. On a 6 month horizon, it's up about 28.2%, and on a year to date basis, it's up about 31.68%. From its IPO price, it is still down around 19.3%, and this continues to be a trend that we are seeing across these new age stocks. Analysts, however, are expecting the stock to do well, with Morgan Stanley even downgrading it from an overweight category to an equal weight category, and has raised its target price to about 460 rupees. If the stock performs well and the momentum that we've sort of seen in terms of the financial continues for the coming quarters, in the short term, it could also hit the 500 to 550 rupee mark.
Let's look at another intriguing company, and this company has suddenly turned profitable. But let's understand what's next for this company. Yes, you guys are correct. I'm talking about Zomato. Zomato achieved profitability in Q1 FY23, outperforming expectations, and it does plan to remain profitable. Let's look at how it did this, right? The revenue surged 70% year on year, totaling 2,416 crores compared to 1,414 crores last year. That's a 70% surge in revenue. Operational improvements in Zomato's food delivery business, margins increased to about 13.6%. Consolidated adjusted EBITDA was at 12 crores, drastically improving from a loss of 152 crores in the same quarter last year. Consolidated net profit was at 2 crores compared to a net loss of 186 crores a year ago. 1 year ago, it had a net loss of 186 crores, and now it has a consolidated net profit of 2 crores. The tax credit of 17 crores and other income helped the company to boost its bottom line. Let's look at the income statement for Zomato, right? The quarterly income statement is right in front of you. And as we can see, there's a YOY year change in the revenue for 70%, operating expense by 46%, net income has risen by 100%, which is double. The margin has doubled again. Earnings per share seems pretty nil. The EBITDA right now has also sort of increased by 77.91%, right? So overall, everything looks good for the company. Now look at the positives, right? The food delivery business's gross order value has increased from 6,425 crores last year to 7,318 crores in quarter one financial year 24. Zomato Gold has positively impacted frequency of orders and contributes 30% to the GOV, right? Blinkit, which is the fast commerce business, turns contributionally positive. The management expects positive adjusted EBITDA breakout in the next 4 quarters. Hyperpure, which supplies restaurants, saw 126% year on year revenue growth to 617 crores in Q1 FY24. Management expects 40% year on year top line growth in the next few years. August saw Zomato tinkering with its monetization strategies. It increased platform fee from rupees 2 to rupees 3 for users in tier 2 cities. The AI chatbot launched to help users find food items is another positive indication for the company's growth, right? Now, we should also acknowledge that investors are cashing in. The lock-in period ended following Zomato's acquisition of Blinkit, with significant investors offloading shares, such as SoftBank, which owned 3.35% stake in Zomato. It sold 10 crore shares worth 940 crores on August 29. SoftBank will likely exit completely. Tiger Global Management also liquidates its entire 1.44% stake in Zomato for 1,123.85 crores, right? Now let's look at the stock price of Zomato. This is a 6 month chart that you can see. The Zomato stock has performed well in August. The stock increased by 14.29% in the month, and it ended at 97.20 as of Friday. On a 6 month basis, it is up 78%, and on a year to date basis, it is up 61.19%. From its IPO price, it is still down around 22.86%, but it has largely been an upward trend from last year. Zomato shares have slowly shown volatility and have hit 100 at multiple times during the week, which appears to be the resistance. If it crossed the 100 level, the breakout could push the stock upwards of 110. From a support perspective, close below 96 could push the stock down to 88 as well.
Nykaa, the beauty and fashion e-commerce giant, posted a quarter one FY24 net profit about 5.4 crores and an 8.2% year-on-year increase. Revenue and gross merchandise values have also seen strong growth, largely attributed to the beauty and personal care segments. While the fashion segment showed signs of some recovery and operating expenses have risen, there are also a lot of questions that are being raised in terms of the recent top management exits that the company has seen. But let's sort of get into that after we look at the financials. So here they are for you. As you can see, the gross merchandise value has increased by about 24% on a year-on-year basis to 2,667 crores in quarter one of FY24, and revenue has been up by about 23% to 1,421 crores. In terms of EBITDA, the company has seen the EBITDA has grown by about 60% on a year-on-year basis, and about 4% on a quarter-on-quarter basis to about 73.5 crores. Total expenses have risen to about 1,418 crores, which are up about 23.5% on a year-on-year basis, where traded goods that have been purchased was a major contributor. In terms of net profit, like you mentioned earlier, it's up about 5.4 crores, up about 8.2% on a year-on-year basis, and 138% sequential increase from quarter four of FY23. Few positives for the company, so let's quickly look at them. Management expects the business to remain profitable and is targeting a 40% plus year-on-year top line growth. In terms of the fashion vertical, the contribution to the gross margin value did contract to 24.5% in quarter one of FY24 from 27%. So that's something that we need to sort of look out for. However, in the other verticals, Nykaa Man, Superstore, the GMV has increased by a phenomenal 92% on a year-on-year basis to about 16.33 crores, contributing nearly 6.1% to the consolidated gross merchandise value in quarter one of FY24. Nykaa's beauty personal care products vertical drove the large majority of the growth for the GMV, rising 24% on a year-on-year basis to about 1,850 crores. There is a lot of focus on cost improvements that have led to better financials, but there is a lot of room for improvement here. It's really focused on customer retention, which has meant that the business from existing customers had contributed significantly to Nykaa's growth in the current quarter and in the last financial year as well. However, what we need to note here is that there have been multiple high-level management exits, from ranging from the chief marketing officer, the Superstore CEO, the chief business officer, and many more. However, what Falguni Nayar, the CEO, sort of maintains is that this is not a significant erosion of talent within the Nykaa pool. It is actually just an attribution to the growth that they're seeing in upgradation of its talent pool and getting more people within the company to sort of elevate and rise to these new positions. Challenge that we need to sort of highlight here is that Reliance's retail fashion vertical Tiara may show tough competition to Nykaa's core beauty business, and that's something that we need to sort of keep a key eye on. Let's quickly look at the stock movement and how that has sort of progressed for Nykaa in the last few months. Most of the new age stocks have performed well and have bounced back this year compared to the sharp drops that we saw in 2022. However, Nykaa has been under pressure this entire year and even last year as well. For the month of August, the stock fell by about 8%, ending at about 135 rupees as of Friday this week. On a 6-month basis, it has moved sideways and is down by about 8%. On a year-to-date basis, the story doesn't sort of improve. It is down about 12.79%. If you look at its IPO price, it's down by about 65.58%. So all in all, I think Nykaa appears to be a very volatile stock. It could touch around 170 if things sort of go in its way. The bottom side sort of expected right now from an analyst perspective is around 120 to 125. It is a stock that is again very volatile. We haven't seen sort of strong positive market movements yet for the stock. However, there still seems to be a strong story that is coming out from Nykaa, and that's something that we need to sort of continue to watch and look at. Right, this quick deep dive into the new age sector stocks, specifically these 5 companies that we were looking at. There is a lot more that we can do here, and we would love to get your feedback. So please feel free to comment, subscribe, and like the video. It really helps us out in terms of the engagement that we're trying to build here and try to reach more people. Comment on what other sectors you want us to cover. Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Don't forget to like this video and subscribe to the Wright YouTube channel. We will be back with many more insights, reviews, and market updates in the coming weeks. Till then, click on the bell icon to stay tuned for more such amazing Wright updates. Happy investing.